Welcome to simplerstocks.com. My name is Don Kaufman. I'm going to take you through a little bit about the week ahead, and let's just look directly at a trading idea right off the bat over here. Here we are on Sunday evening, and I happen to be looking at the USO, which of course is the United States Oil Fund Limited Partnership. Now, if you do trade the USO shares, just be aware it happens to be a limited partnership. That means, okay, if you're in a taxable account, you have to file what's called a K1. That might not be wonderful for you. If you trade the options, that's not necessarily true. With that, though, taking a look at the USO, or more specifically oil, if you're more comfortable trading the oil contract itself. What's going on over here? Okay, just in recent trading sessions, of course, in the last few weeks, we've seen oil rebound. Again, specific to the USO over here, from 1561 all the way up, okay, into the low 20 region. And at the same time that this rally has been going on, we've actually seen implied volatility drop off, and quite readily. Okay, what I'm actually looking for here happens to be a little bit more of a breakdown in the USO. Okay, possibly this coming week. That is just a little bit more selling pressure likely to take the USO. Okay, ultimately down back possibly towards the 19 level over here, again in the USO. Now, if you're not necessarily comfortable again with the USO, you can be a little bit more specific here, and we could look directly at oil. Very, very similar setup over here. Almost looks like it's starting to roll over, and that's exactly what we're expecting over here. Now, as I mentioned, that kind of 19 level in the USO. All right, so we'll go back to the USO momentarily. You're like, hey, where'd you get that kind of 19 level? Because in the USO, down here at this 19 level, you may not necessarily see any specific support or resistance. Okay. However, if you do look over at the oil contract itself, and that's where I'm headed right now, back over to the oil contract, that 19 level represents somewhere in the neighborhood right here about the 56 level. Okay. The USO doesn't track oil perfectly, but it's a pretty good representation of oil. Okay, although if you hold the USO over the long duration, and we're talking about many, many months or even years, the USO is not going to do as good of a job as tracking oil as one might have originally believed. So the 19 level in the USO kind of corresponds to about the 56 level over here. Again, looking for oil to back off in the coming trading sessions. A couple of different ways you could trade this. Of course, you could just get outright short the USO. Outright short a product, it might not necessarily be for everybody, okay? This is a $20 product. It's going to tie up a lot of capital. Another way you can actually consider, all right, just a little bit of a short position inside of the USO. You could use, for instance, some type of weekly options. Now, granted, if you're more comfortable with stock, that's fine. If you're more comfortable with futures, okay, oil futures, that's a big tamale. That is one large contract to be able to trade. Myself, when I look for setups like this, and I want to stay defined risk, okay, and why might you want to be defined risk? I'll tell you exactly why you want to be defined risk. All right, during the course of this week, there's different announcements and so forth that come out, and you always got to check the calendar ahead. So you look at Monday. You look, for instance, at Tuesday. Nothing big here on Tuesday. You look at Wednesday, and you're like, oh, there's the FOMC minutes. Don't forget, FOMC minutes coming this Wednesday. But we're talking about oil right now, and there's a petroleum status report, okay? That can rock markets, all right? Specifically, your oil markets over there can be impacted by it, so just be aware of it. So again, if I'm taking a look and trying to build some type of options position over here, I like to set things up, okay, where my risk is relatively defined. Now, there's not, okay, necessarily the only way to do one of these trades. There are umpteen different ways that you can actually build a different options trade here. What I've actually done in this particular circumstance is I'm actually purchasing a put and selling a put. It's a vertical spread, and I'm buying a spread. And I'm buying the 2150 puts, okay? Those happen to be in a 19-day expiration, 19 days remaining to expiration. So I'm buying I'm buying a 19-day expiration. I'm buying the 2150 puts, selling the 1950 puts for $1.03 debit. roughly, it's a $2 wide spread that I'm paying $1 for. And the 2150 puts, they're already in the money by $1. The trade is really simple. It's risk a buck to make a buck. So how do you make money? You're right. If you're right, okay, and this product, okay, in the next 19 days dips down, all right, to 1950 or below, you're a winner. If it rallies up above, for instance, 2150, you're a loser. Very nice thing. You risk a buck to be able to make a buck, or you could do 10 contracts, risk 1,000 to make 1,000. It's a straight 50-50 shot over there based on a little bit of technical analysis. Thanks a lot, everybody. Bye-bye.